In this episode of On the Tape, I welcome back Cameron Dawson, Chief Investment Officer at NewEdge Wealth. I met Cameron over 13 years ago before she began her career on Wall Street, and she's become an important voice on the street, and the combination of her work ethic and research is unmatched in my opinion. We discuss the health of the U.S. economy and the stock market as we kick off second quarter earnings. Cameron shares her views on the Fed, tariffs, and where we are in the economic surprise cycle. We talk about the wealth effect and the impact it is having on both the market and the economy. We touch on market breadth and the factors that are driving investment decisions. And just like the Mozart effect, which is a theory that listening to his music makes you smarter, the Dawson effect will make you smarter when it comes to the markets. So please enjoy this episode of On the Tape. Welcome to the On the Tape podcast. I'm your host, Danny Moses, and today I welcome back my friend and Chief Investment Officer from NewEdge Wealth, Cameron Dawson. Cameron, welcome back.
So happy to be here.
So for the new listeners, as a way of background, I met you in 2012. You were the recipient of the Edward Moses Award for Outstanding Potential in the field of finance in 2012. You have exceeded, I'm sure, any of those expectations. That was the second year we gave out that scholarship. And you were undergrad at Rollins. You did that in 3 years, and you were valedictorian. I don't want to steal all your thunder. And then you went to Crummer, which is the Graduate School of Business at Rollins, and I'm sure you were top of the class there too, and you got this award. And that's where we met.
Yeah.
So, and that was amazing. And having watched you over the last, it's been 13 years.
Yeah.
I mean, amazing. Watch you grow and change firms and where you are now and the impact you're having is incredible. So thanks for coming back on the pod.
Well, and I have to continue the gratitude every single time that I see you, because I would not be in the position where I am today if it were not for that scholarship and for the encouragement that it gave me, but also the ability to wait for the right job and have the confidence to pursue a career in this fascinating space. So I wouldn't be here if it wasn't for you. So thank you.
Well, it's all the shame is that you never got to have my father as a professor.
Yeah.
Forget dean, but he taught finance, and I know how much he would have liked you. So fast forward a little bit here. You just gave the commencement address at the Crummer School.
I did.
I watched it. It was like 12, 13 minutes long. It was very inspiring. How was that to go back and give that speech?
Oh my goodness, it was truly a thrill of a lifetime. And one of the things I encourage the students to do is write their dreams down in the speech and say it's the first step you take to committing to a goal, committing to a dream. And I said it in the speech, and people laughed when I said I don't think that they took me seriously, but I had actually written down that I wanted to give the commencement address at Crummer back about a year and a half ago. And so when Dean Minin sent me an email and said, would you be the commencement speaker, I practically jumped for joy. I cried a little bit. I was so excited. But it truly was an honor to get to talk to students with the retrospective of just 13 years ago. I was sitting in their seats and I was bewildered just as much as they are. And the world is just as uncertain today as it was back then. There are a lot of similarities. We were just coming out of the great financial crisis. Finding a job was tough. And so what I tried to do was give the kids many of them are probably older than some of them are older than me. There's doctorate students in there, some tools to help find their purpose in what I called a sublime life. And so hopefully some of it resonated. It certainly was an impactful process for me to go through doing the speech. So very honored.
Well, it was very inspiring. And you talked about being kind and how that carries you in life. And you talked about how if you listen closely, there's Shakespeare in the stock market, ballet in the bond market, right? Yeah. Just let it come to you a little bit. And I love the story. And I tell people all this all the time. Moving to New York is a 2-year graduate degree in life. Now, I feel like, not to quote Sinatra, but you make it there, you make it anywhere. And the story about the 5-floor walk up, you wired your life savings to some guy. You had no idea where it was going, but you made it through. And look at the journey that you've been on. It's really been incredible.
Well, the best part of that story is that he showed up an hour late. So I'm sitting on a stoop in Hell's Kitchen, going, "Oh
Monty,
my gosh!"
I believe Monty.
His name was Monty, and he didn't show up. But I think that's that sort of trial by fire, and knowing that there is no safety net. I didn't have a safety net at that point, and trying to make it all work. And I wouldn't be here. And the whole point of the kindness discussion is that I wouldn't be here today if it wasn't for you, if it wasn't for people like Dr. Singleton from Crummer. But there's so many different people in my life, from my bosses at Bank of America, from my bosses here at NewEdge, where I am today, that if it were not for their kindness, for their belief in me, I wouldn't be here today. It's a very humbling thing, and all the things have to fall into place. So it's pretty darn cool. I pinch myself, and I'm glad that I'm no longer in a 5th floor walk-up. I will tell you that.
All right, we're going to get into the markets here, but before we do, there always is a pop culture reference or something, and you're I mean, you're a student of history, you're a student of the markets. Do you know what the Mozart effect is?
Yeah.
So the Mozart effect is if you listen to Mozart, you're supposed to become smarter.
Yeah.
I'm going to call this the Dawson effect.
Oh,
right?
goodness.
So if you listen to you, you're going to be smarter about the market. So we're sitting here, I believe, and I think you will agree, we're at a massive inflection point. We've kind of not the limits, but we're in the upper bands of a lot of different things on the extremes, on breadth, on rates, on PE and so forth. So the timing of this, we just kicked off second quarter earnings. We always start with the banks, which are kind of the most predictable, right? Because you can kind of gauge between BlackRock and the asset managers. You kind of know what their assets are. You know what their fees. Banks, unless there's some credit provision that we didn't know about, it's pretty steady. So as we sit here today, and CPI also, and a lot of inflationary numbers. So give me your current thoughts, kind of on the market and what you're expecting to see in second quarter earnings.
Certainly. So it's as if we have this rubber band that we continue to pull, and we are not sure how much elasticity is left in the rubber band. And at some point, it's going to snap where you hit those extremes and you start to see a bit more reversals. But one of the key things that we've been arguing since the April lows is that positioning got so deeply underweight. The tick at the bottom of the April sell-off was in the first percentile for the Deutsche Bank Consolidated Positioning Report. So people just went massively underweight stocks in response to tariff fears and then the enactment of tariffs. And what was fascinating is that they were so slow to get back into stocks and that they lagged in chasing the rally higher that we kept saying, here we are again with positioning that's still underweight equities. And so we likened it to do a pop culture reference to this idea that instead of a bull or a bear market, we were in a honey badger market. And the honey badger, if people know, is the most fearless animal in all of the animal kingdom. And the honey badger loves risk. So think about high beta and risky stocks leading. The honey badger is fearless, meaning it's like the market. It ignores things like tariff headlines. And there's a great line about the honey badger. It says, nothing stops the honey badger when it's hungry. Well, nothing stops this equity market when investors are underweight equities. So now we're at a point where we think that positioning is more neutral. It may not be quite overweight yet. We got the Bank of America fund manager survey this morning that showed that cash positions have fallen and people are much more bullish about the outlook. So you're no longer in a point where you're saying, there should be more bulls given how good returns have been. And so we think that you've lost that as a tailwind, and now it's time for the fundamentals. And we think that this earnings season is actually less about the results that we get, more about the reaction to the results. We know that companies are going to pull out all the stops to deliver earnings because they're going to do some inventory management and they will try not to make tariffs seem as big of a deal. But how much of that is already priced in? And maybe we're seeing that in the bank reactions as you saw the banks sell off in response to pretty okay news.
Yeah, I saw Wells Fargo. I just think, the net interest income was a little bit disappointing, but nothing crazy. But the stocks have run up. There's certain sectors like banks and home builders where you get to a multiple of book and you just really hard to get much higher unless there is a secular change. The secular change for banks is deregulation and things that have gone on, right? Those are, but I think we've kind of adjusted to that. And so you can't meme a bank, I would say. You can't meme a builder, so to speak. So those are tangible things. I think that's the difference in those type sectors versus kind of the AI.
Yeah, if you look at the last 10 years, and you can even zoom back to just the full post-GFC period, banks have traded at a peak valuation. Every single time they got to a peak was at 1.5 times book. And that's exactly where they are today. So the question is there enough of an inflection point in the return on equity generating capacity of these banks or the ability for them to grow earnings to a certain level that you would expect them to be able to see a higher book value in aggregate than more than 1.5 times? Look at a name like JP Morgan. Right. At the beginning of 2024, it was trading at 1.6 times book. It's now at 2.3 times book. If I'm Jamie Dimon, that may be one of the reasons why I keep trying to temper expectations, because now I'm a momentum stock. And momentum stock means that you don't control your destiny as much. You're trading at such a fulsome valuation that even good news may not be enough. So the question we have on the banks is that, okay, we know we're going to get some deregulation, likely. Maybe we get some capital relief. Are there reasons to think that this is a secularly different backdrop for the banks? Maybe one thing to consider is that because private credit is doing so much of the lower quality lending, people are looking at the bank balance sheets and being like, these guys are actually
it's
better
different
now.
This time. Right.
Maybe it's different this time, but how many turns of multiple is that really worth? I don't know.
I think the irony on the bigger banks is that if things do slow down in the economy and there's credit issues, not massive credit issues, but enough in C&I lending and the regionals, they're going to be acquiring all the regionals. So if any of these smaller, mid-sized banks either stop growth or get in a little bit of trouble, so to speak, I think they're going to be all takeout targets because what deregulation will allow. So if you want to argue and look into the future that there will be using your stock that's expensive to make accretive acquisitions, I know this is not for 12 to 18 months probably, but that's what I actually think is part of the backdrop also, which is why kind of the small and mid-cap banks, which give you a better read of the economy more than these Wall Street banks, will be very interesting to watch. And if things do start to turn there, I wouldn't be so quick to short the KRE per se, because I think these big banks are waiting for it because who's going to stop them from making these acquisitions? So I feel like that's part of the backdrop there.
Because what we need is
just
even bigger banks.
Even bigger banks, exactly right. So you just mentioned tariff in April, and one of the things I want to go back to is kind of the U.S. dollar. And I think that the U.S. standing in the world on the global stage, I think was part of the sell-off that drove the sentiment so negative. We have come back in the stock market kind of obviously all the way and higher, but it still feels like we're going to be carrying, we are carrying a lot of these, hangovers and, current drinking, if you want to call it, of tariffs right now. We still don't know where this is going to play out. So the dollar's come down a lot. Should people be paying attention more to the weakness in the dollar? And I'll add to this that you covered industrials at Bank of America for years. And there's no better sector to understand tariffs and the impact of the U.S. dollar probably than that sector. So give me your landscape right now of what
I
people
have a
should pay
bone to
attention
pick with the industrials and where they're trading on a valuation standpoint. But on the dollar, to throw in a pop culture reference, I am going to see the Pixies tonight. So
nice. Brooklyn Bowl, where are they?
Brooklyn Paramount.
Okay.
Much
Is that a
bigger
step
than the
below Brooklyn Bowl?
No, it's a step above.
Okay.
It's a much bigger venue.
Okay.
It's the Pixies. Come on.
Got it.
And so they have a great song called Debaser. And so how much is this about dollar debasement and fiscal fears?
Yep.
I think the fiscal fears, one thing to note is that this is definitely a global phenomenon, because look at what's happening in 30-year bonds across the globe. It's JGBs, it's German bunds, it's U.S. Treasuries on the 30-year side of things that are drifting higher or continuing to move higher. And each of those countries I mentioned are all talking about fiscal expansion. So clearly there's some concern about debasement, but of course we know that currencies are a relative game. And so when we think about the US dollar and its prospects going forward, it's important to see all the different aspects and roles that the dollar plays within the global economy. You have one part of it, which is a true reserve currency. So central banks holding dollars. And the question is there less demand for that at the margin because of some of the actions that have been taken over the course of the last 6 months? But I would also argue over the course of, let's say, the last 4 years, ever since Treasury really started to weaponize the dollar in a more meaningful way following the Russian invasion of Ukraine. So you have seen more gold buying by central banks, less dollar buying at the margin. Then you go on to the trading flows. And the fact is that if you reduce trade activity, you reduce demand for dollars, and thus you see this incremental lower demand for dollars because of the tariff policies. Then you go into the investment portion of things, and we think about the capital account, right? So we have a big current account deficit from trading, a big capital account surplus from all of the investment activity. And that's where we're starting to have questions of, is there less demand for dollar from that investment side of things? And the answer seems to be real money buyers, likely yes at the margin, and it's showing up in hedging activity. We're seeing really big short positions get built within the dollar and international money market futures. And that's just one tiny snapshot. So you can't use that to say everybody's short the dollar. But what you can see is that people are having to hedge their dollar exposure because of dollar weakness. It's sort of weakness begets more weakness, begets more weakness. Very similar thing happened in 2000 to 2007. So when you put it all together, between all of the policy changes, all of the kind of slow moving tectonic shifts of some of these structural changes in the economy, it suggests that a dollar downtrend is somewhat entrenched. However, as we know, things never go in a straight line. So because we've had such a sharp move lower and you have this big short position, don't be surprised if we have a counter trend rally in the dollar. And that's going to shock everybody, because everybody say, wait, I thought the dollar was dead. I thought U.S. exceptionalism was dead. It might just be more of a trade positioning kind of rally.
Yeah, it's a great point. And this whole idea of these tariffs is that, trade imbalance. Well, you go after Brazil for two reasons. One is the treatment of, a former president there, but also because of this BRICS potentially creating their own type of currency. So you know that's part of the backdrop there to go after certain countries that could actually help debase the dollar, but also this stablecoin phenomenon that's been going on as a way to kind of generate demand for U.S. Treasuries more in the short end, obviously, of the curve. So Bessent is probably behind the scenes trying to figure out how can I marry this policy that I can't control to kind of help the market, because they're all focused on what is the most important thing, which is 10-year yields. And so we sit here right now, we're at 448, approaching 4.5% again. That has tended to be the level. Why does that level matter so much? And, if we bust through that technical level, what are the ramifications on where the stock market's trading relative to where bonds could go?
I mean, it's such an interesting question. There's so many different threads to pull on there. The first one being is that if we think about the stock bond valuation comparison, we always use something called the equity risk premium in order to do that. So equity risk premium is pretty simple. It's the earnings yield, which is the inverse of the PE multiple, minus the 10-year Treasury. And it's effectively what extra compensation do I get for owning equities versus some kind of riskless asset? And we could debate whether or not the 10-year Treasury is a riskless asset. But what you've seen is that equity risk premium has been absolutely infinitesimal for the last few years because valuations have been so high, has dipped negative a few times. And the question would be is that at what point do investors look around and say, oh, yields on bonds are so high, so much more attractive that I'm going to avoid equities and reallocate into bonds. In practice, it doesn't really work that way. We do think about, of course, equity valuations, and we do think that yields are an important component because that's how you discount future returns. But if people are judging themselves as being underweight equities, it doesn't really matter what valuation that they are trading at. So if people are looking around saying, wait, I need more equities, say, well, I'm going to buy them no matter what the price. So sometimes the equity risk premium is a poor timing tool. To get to your point on funding of markets and of the deficit and how it interplays with the yield curve, one of the things that we've been asking a lot is that can we really have our cake and eat it too? So the Treasury seems to be laying out this kind of loose plan, and I use the term plan very, very lightly, with the idea that we can issue completely at the front end of the curve, really focus on bills, not issue at the back end of the curve, where 10-year, 20-year, 30-year, because that's has the potential of pushing up those yields even higher. So let's focus on bills, and then let's install a Fed chair that's going to cut interest rates significantly, and then that will mean our funding costs will fall precipitously because, after all, there are bill auctions every single week. And so the question is, can you really do that? Does that work? And what is the potential cost or ramification for it? One point that's interesting, a gentleman on my team, Brendan Keelan, who does our short-term fixed income portfolios, cash management portfolios, he's been noting that the front end of the curve is already pricing in fewer rate cuts than the Fed funds futures. So you're starting to see a spread where usually we think, when you think about the yield curve, as you move out the yield curve, the Fed has less and less influence on it, and it's more about supply and demand. And what you're starting to see now is potentially this scenario where the Fed even loses control over the front end of the yield curve because of this issuance of so much flooding of the market in bonds. So I'm not an expert on this, but it's something that I worry that we're underappreciated the unintended consequences. It was a long answer, but there we go.
But that's what I've been talking about. If you force the Fed or force their hand or get rid of Powell, whatever, you want to cut short-term rates, that might come at the expense of longer rates moving higher, longer to the curve moving higher, and that's the ultimate nightmare, because then obviously, because you can issue all the T-bills you want, right? You still have, billions and billions of dollars out there, obviously, of longer-term securities. So we'll see how that pays out. But people are focused more on the 10-year. I'm a believer that QE5 is coming. I think, obviously we're pretty much, at least on the Treasury market, we're done tapering, right? We're $5 billion a month, some meaningless amount. Mortgage-backed securities, we're still running off and reinvesting anything above. If rates come in on the short end, you'll have a lot more prepayment on mortgage-backed securities, which would mean potentially take that money and buy Treasury. So they're going to do something to try to control the long run, but I do think it's a very dangerous game that we're playing.
Well,
here.
And it's interesting, this idea of we've been scratching our head of why would you want to get rid of Powell now? he's such a great scapegoat if you have economic weakness, mostly if you are pursuing policies that have the potential to weigh on economic growth. I was with a member, or the head of research from the Dallas Fed last week, and she was talking about their forecast that immigration policy is expected to weigh on GDP growth by 0.8% because of all of the slower flow of people entering the workforce. Then you add on the tariffs, which are a consumption tax, which will likely weigh on growth as well. And so what's interesting is that then you could actually, if you're the White House, you can point at Powell and say, oh, see, like this is why the economy is weak, even though we're pursuing policies that might actually be the key source of that weakness. If you get rid of him, you lose that scapegoat. And I do wonder if you were to see actually 200-300 basis points of cuts, let's say over the course of the next 6 months, let's say they get rid of Powell and all of a sudden they start slashing rates immediately. To your point, the risk you run is a steepening of the long end of the yield curve that would have to come with an environment where the economy is resilient. So you go back to the third quarter of last year, economic surprises were skyrocketing higher. You had GDP forecasts going up. That's why you saw a 100 basis point rise in the 10-year yield. But our concern is more what happens with the front end of the yield curve as you slash it lower and how it impacts the wealth effect. There is $7.4 trillion of money market balances that are absolutely loving and enjoying these high rates. And those money market balances are predominantly held in high-income households, which generate the majority of consumption. The top 10% of income earners generate 50% of consumption. You start cutting interest rates in a meaningful way, that reduces cash interest income, not just to consumers, but to company balance sheets. Does that actually slow the economy? It's such a through-the-looking-glass and very heretical thing to say, but we think it's something people should be talking about.
Well, the counter argument to that is that money will come out of the money market into the stock market to potentially chase yield. I don't think people are going to do that per se, but that would be the other argument against that, right?
Yeah, we've always wondered if they're really that fungible. You see it, you saw a little dip in money market balances during the dip in the stock market, so it looked like people were taking cash out and buying the dip, but you start cutting interest rates, this is a lot of cash that was sitting in bank deposits. Not necessarily cash that was destined for the equity market. So I don't know. It's hard for me to argue like that money is truly fungible. Probably at the margin there will be, but we have to remember, a great parallel is 1998. The Fed cuts rates 3 times in 1998 in response to LTCM. By the time they do the third cut, the Nasdaq is already at an all-time high, and adding that liquidity to the market caused an absolute parabolic move in stocks over the next year and a half. That is the upside risk if we see the Fed pursue these rate cuts, if the underlying economy is strong and resilient.
By the way, you just reminded me, The Rise and Fall of Long-Term Capital When Genius Failed, which is my favorite financial book ever written. And we're sitting here talking about
mine is The Big
currencies.
Short because of one of the characters.
But was, but to me, honestly, as a student of the markets, and reference my father again, I had him read that when it came out, and we actually knew some of the people that came from Solomon at Long-Term Capital. He actually used it to teach in his class as a required reading. And we're talking about here about dollar at certain levels, and the yen at certain levels, and bonds globally. These are all those things. And so we've had situations in the last 3 or 4 years where you've heard about, funds are blowing up, someone's getting carried out, oil went negative, yen got destroyed, somebody's getting carried. We're going to have those moments in time, and we have recovered from every one of those that has happened. One of these, I would call like a mini crisis, so to speak, but you wonder at some point if there's something. So you just brought up wealth effect as it relates to money markets, and I want to talk about the wealth effect in the stock market and the impact that it's having. Never has it been truer that the stock market's not the economy and the economy is not the stock market. Yeah. This has to be the most bifurcated we've ever had. Would you agree to that? And how is the stock market feeding on the wealth effect? And I say that because it wouldn't take a lot for the market to turn lower and all of a sudden change the mood and the spending patterns of the high-end consumer, in my opinion.
Yeah, I think that the caveat to that is that it has to be a protracted move lower, right? So because we saw the big move lower and it lasted a blink of an eye in April, that wasn't enough to really shake spending patterns. Maybe we saw it. I mean, consumption has slowed pretty significantly through the beginning of this year. Some of that is tariff pull forward, but there could could be an aspect of a waning benefit from the wealth effect. One of the things we look at really closely is FINRA margin loan balances, and FINRA publishes them every month on the third week after the prior month. So we should be getting an update here within the next few days.
So people out there, just want to make sure that's basically people taking leverage in their equity accounts to buy stocks.
Yeah, and it's such a helpful indicator because it tells you risk appetite. If people are taking on more leverage, they are ultra bullish. They're dreaming about the future of everything that can go right. But what's interesting about FINRA margin loan balances is that they do tend to roll over before we are at a top in the market. And I think the reason for that is that the Venn diagram of margin loan plus really risky stock bets is actually has a fair degree of area that overlaps it. If you're risk seeking in one area, you're probably risk seeking in the kind of stocks you're owning. And so what happens is that as you're entering the later part of a cycle, the flies start to drop a little bit and people start getting margin calls and people start saying, I need a little bit more buffer, and that margin loan debt comes down. It still is rising as people are still very bullish and taking on more risk, and it has yet to make a new all-time high, but certainly something to watch as a sign of a kind of risk appetite.
Is that just the retail component, or is that also the institutional component?
That's just retail, so that's just FINRA, yeah.
And what have you seen on the institutional side? You can see that in the prime brokers reports, correct?
Yeah, the institutional side looks to be still just in the neutral territory. I thought that was an interesting catch within the B of A fund manager survey. They're like, it's toppy, it's super bullish, and then they're talking about U.S. equity exposure, and they're saying, well, you've seen the biggest inflow into tech stocks since 2009, but overall U.S. equity exposure is still fairly light. So that would say is that I hate to keep saying it, but the pain trade still feels higher, and meaning that if we do get dips, maybe they're shallow before we get something that's a bigger type of correction, because that's what set you up for the beginning of this year. You went into this year with everyone's bullish, everyone's long, everyone's optimistic, and there was just so much room to surprise to the downside. I think what's interesting is that there's this big divergence between what the market is pricing in as far as an optimistic scenario and how people are positioned. That's fascinating, because the market's pricing in an incredibly optimistic scenario, whether we're looking at earnings or valuations, but participants aren't necessarily saying, oh, yes, I believe it. There's still a lot of doubt. And sometimes that doubt has to wane a bit more before we actually see people get caught flat-footed.
And that would be why the pain trade would be higher. So, where are we on the economic surprise side? Because I feel like we've been disappointed surprise. Where are we on a relative basis to that as we sit here and going into the next slew of economic numbers that are coming out?
Yeah, we've seen economic surprises turn up since we got that better than expected non-farm payrolls. That certainly helped. Some of the soft data has been rebounding after it was absolutely in the doldrums. It's an oscillating mean reverting index. So once it gets really bad, it kind of by definition does eventually turn up. So we're watching this week with retail sales. That's the next big one, and watching there things like restaurant spending. So restaurant spending is something that is less impacted by the tariffs, maybe somewhat impacted tangentially because people are spending in other areas, but usually that's a good sign of how people are feeling about their own financial situation. If they're going out and eating, things are pretty good. If they're starting to stay home more and pinch pennies, then you might be seeing a little bit more conservative behavior. I know there's a great interview with somebody from Bank of America about the dispersion between their different client bases, and it was on surveillance on Bloomberg last week. And she talked about how maybe not the first time, but really notably, the low-income consumer is significantly pulling back. So maybe this is our sign that tariffs really are weighing on certain cohorts of the consumer, but those people buying $10 million Birkin bags may not feel it.
This is why I brought out the stock market's not the economy, and so forth. So one of the things I watch, and it's hard to tell if it's the cart or the horse. Credit spreads are the be-all, end-all. They really are. When you see a market sell off, you look, credit spreads are widening. Well, did they widen because the market's selling off, or is there a reason, to your point, is that on the lower-end consumer, we're starting to see stress in some of these some private credit potential, what's happening? So this is what I'm like. So when Treasury yields move higher, I think corporate high grade corporate debt is a great place to be if we get kind of a break in, high yield spreads credit spreads start to widen. But do you watch credit spreads, and do you think it's more of a thermometer, or do you think it's a cause and effect?
Yeah, we've been wondering how much there's a structural dynamic with credit spreads that are keeping them not necessarily as wide as you might expect given the risks. Because what you've seen is very little issuance of high yield debt, partially because you have seen potentially some issuance be peeled off by private credit, kind of, this like taken private of those that might have issued in that space. But you've also seen the average maturity of high yield debt continue to fall as companies delay issuance as much as possible, hoping and praying that they're going to get lower rates. And so then that way they get a chance to issue debt at more favorable terms. So the other part of it, though, is that as you've seen supply come down, demand for high yield has remained very high because all-in yields are still high. So yes, the spreads are tight, but because your base yields are high, you're seeing this ravenous demand. People going, oh, look, I can get high single digits on high yield debt. That's still attractive in the grand scheme of things compared to everything else. One thing I'd note is that since the beginning of July, this could be just quarterly rebalancing. We watched something that's the triple B, double B spread. So it's the lowest of investment grade compared to the highest of high yield. And that spread has started to widen out in the last 2 weeks, not confirming the new all-time high in stocks. So
is that more because the investment grade is tightening, or is it
I'm
because
not sure which one is driving it.
Yeah.
But you would expect, some kind of confirmation that aspect of credit spreads should be telling you everything's okay. It's not enough to cause a red alarm, right? We're not pulling any alarms yet and saying it's all over. But we're saying, okay, well, let's watch this closely, because if credit spreads don't confirm the new highs in stocks, that's your signal. That's much more important, because that tells you that the credit market is saying, hey, equities, like, have fun dreaming the dream. We're looking at fundamentals and they don't look so hot. But we've not really seen that divergence. Well,
this is the danger. I'll bring it back to the Fed again. If the Fed were to cut prematurely and the long end yield started to move higher, credit spreads would widen dramatically. In my opinion, that would happen because everything's relative, right, off of the Treasury curve. But we'll see what happens. So as we see here today, PEs are rich, but valuations never a reason to either not be involved in the market or sell. Give me your landscape of small cap, large cap quality, large cap growth, small cap value. Where are we today, and where are you recommending that people kind of allocate?
Yeah, so we continue to have a balanced view of where we want to be allocated between U.S. large cap, between growth and value. We are equal weight between the two. I call this our list of high conviction neutrals, because there's puts and takes within growth versus value, where growth is extraordinarily expensive. It's trading at 28 times forward, but it's got the earnings growth. Value, it's not cheap versus its own history. It's cheap relative to growth, but you continue to cut earnings forecasts. So when we think about growth, investing, we're having to pick our spots carefully and ride the momentum. And then on the value side, we're sticking to the highest quality portions of the market, not trying to get caught in value traps and things that are cheap for a reason. We're finding a lot of opportunities within the mid-cap space. Some of that has benefited from the big high beta move that we have seen over the course of the last couple of months. But we're picking our spots in mid-cap, far less confident within small cap, just because the indices themselves are so low quality. Within international, it's been a great year for international investing. Some of the relative performance has faded over the course of the last couple of months, but we're still finding some relative value within international markets. But again, the quality overlay is really important. Stock selection is important. And that's, if we think of the value, the mid cap, small cap, and international indices, that's where we argue that there's a lot of value to be added with active management and active selection of stocks, because the indices are far less concentrated. There's a lot more dispersion between winners and losers. There's a lot more occurrence of junk in those indices. And so you can actually add a lot more value by being selective within those industries. versus when you compare it to the Russell 1000 Growth Index, where the top 10 names are nearly 60%. It's a really, really hard index to outperform and maintain any kind of controls on concentrations.
So people talk about factors. What is the most important factor? Quant funds are built upon these. What do you think right now trending factors are? Is it as simple as higher earnings? Is it revenue growth? Is it interest rates? What is the factor you think that people should be watching and kind of 2Q that's going to drive flows?
Earnings revisions have been a really important factor over the course of the last couple of months, which we think is one of the reasons why you've seen growth lead again, because growth has had the earnings revisions higher and value hasn't. One of my favorite analysts, and every time I don't listen to him, I always kick myself. And every time I do listen to him, I'm always very grateful, is Jeff DeGraff. Mm-hmm. And back in April, he put out this note and he's like, don't let beta bite you. It's in the first percentile, meaning it never has traded worse than it is today. And so he made the call of like beta is going to outperform, and it's gone from the first percentile performance, which means only 1% of times it's had worse relative performance, to now it's in the 98th percentile. And so he's been saying, beta might have kind of run its course. That doesn't have to be a death knell for a rally, but certainly changes the flavor of the next leg of the rally. Maybe it's not as risk on. Maybe it actually is more driven by fundamentals versus just give me juice, which is what beta is.
Yeah, Jeff is a friend. He's a great strategist, does great work. He'll be on here hopefully soon for sure. I remember back in 2009, housing starts were the be all end all. I was watching it for what it meant for housing. And we had an analyst in to see our team, and he literally said, he goes, let me be very clear on this. There's no housing starts. So your inflection, your factor, if you want to say it, the stuff you're doing in banks and mortgage land, it can't get worse. To your point about beta chasing in the 1 percentile, it was the same exact, literally, I swear, it was March 9th, 2009.
Oh, wow.
He was in our office, this guy. Of course we ignored.
Yeah.
Why would we listen?
No, you were so right.
Yeah, exactly. No, but I'm saying is that you have to pay attention to those things, to your point, and say, so a lot of smart people out there talking. So as we sit here today, the markets are obviously expensive. But again, tell me, guys like Lou Bell, who's a friend of mine who works at NewEdge, greatest guy ever. What are you telling their clients, kind of the RIAs, and how to kind of position themselves, based upon everything that you're talking about right now?
One of the things that I think it's important to do in some respects is think of equities with an illiquid mindset. And this is not to say that we should ignore volatility, but there's a portion of portfolios that it is best to let them compound over time. And you can let them compound over time if you're invested in quality areas, because quality areas tend to go down less in down cycles and still participate in up cycles. And that can be the peace of mind for an individual investor to say, okay, how can I not knee-jerk reaction when volatility strikes and sell at the wrong time? Because I say often, the worst thing that any individual investor can do is sell at the bottom and be too afraid to get back in. It's really the only way to destroy wealth over the long run, mostly in a market like the S&P 500 has been over the course of the last 50, 60 years. So we think that it's an important aspect of having a steady hand through things. When it comes to valuation, it's such an important discussion, because every number that we can run on forward returns from valuations on these levels paint a pretty scary picture, talking about very low single digit, mid single digit kind of forward returns when you're starting at these high valuations. And we argue starting points matter. It's far easier to have fantastic returns when you are starting from a time like March 9th of 2009, when everybody is underweight equities. Equities are trading with single-digit PE multiples, and you're seeing huge stimulus and liquidity starting to flood in, and everybody's washed out, and earnings are depressed. It's such an amazing time to be buying equities. Today, it's the exact opposite. You have household stock allocations that are near multi-decade highs. You have valuations that are stretched. All of these things suggest, and Barry Bannister from Stifel puts out a great model about this, of projecting forward 10-year forward returns based on that. The challenge you have with that is that if I were to tell you with absolute certainty with a crystal ball, you're going to get 3% on an annualized basis over the next 10 years. I'm not saying you will, but let's say I knew that you were going to get 3%. That tells you nothing about the path that it takes to get there. Right. You can have a massive rally and then a crash and find yourself at 3%. You could have a crash and then a recovery, find yourself at 3%, or you could oscillate along and find yourself at 3%. So when we think about valuations, we always have to marry it with the tactical side of things, because we could say that valuations were expensive today, 6 months ago, 12 months ago, and if that kept you out of the market, then it was the wrong decision. What we argue with valuations, the way to think about them, is that instead of being a decision tool as to whether or not to be invested, think of them as an amplifier to potential moves when a catalyst emerges. So if you're trading at a low valuation, it doesn't take a lot to get big upside moves. If you're trading at a high valuation, you are exposing yourself potentially to more downside risk if a catalyst emerges. And so that's when we always have to be on catalyst watch. And what we'd say is that the higher the valuation, the more the potential volatility. It's like a Minsky moment, right? So Minsky is all about the idea that low volatility breeds the conditions for high volatility. So high valuations are bred in environments of low volatility because everybody feels great. That creates the conditions for high volatility whenever that catalyst strikes.
So to quote another Pixie song, you want to avoid the wave of mutilation.
You want to
avoid the wave of mutilation.
It's all I think about now.
Yeah, right.
That's another Pixies.
Oh, that's another one.
Pixie song.
I'm not a Pixies person, but
but
I know some of the songs. So,
yeah.
All right. So last thing, I got to get your thoughts on this. Have you come around on Bitcoin? What are your thoughts as its place as an investment? Mm-hmm. I've talked about it. I was never bullish on it. People should be scared that if I go start buying it, they should probably sell at this point. But I respect the people behind it. I think they're brilliant people, and I see its place in this debasement world and lack of faith. So what are you telling people? Do you give advice on Bitcoin at all?
Here comes your man to promote Bitcoin. Look, we think that there is a very specific role that Bitcoin can play in portfolios, and it's important to disaggregate what causes, in our view, why Bitcoin rallies at different times and struggles at other times. So we think it's a debasement fear that is a big portion of what Bitcoin is. And we consider Bitcoin to be a psychological commodity. We put it in the realm of real assets, and we call it a psychological commodity because, like gold, in many ways, it is the concern that you are going to see ample money printing, debasement of currencies, and thus I want something with a relatively fixed supply to be able to hedge against that risk. And so when you have the fear of debasement, you actually don't even have to see the debasement play out. You just need enough people to be afraid of it to all agree that we need this asset to protect against it, hence the psychological commodity. The other important component that you need for Bitcoin rallies is an ample liquidity environment. Because if you go back to a year like 2022, you still were, of course you were seeing money supply growth come in and actually shrank over, a short period of time. But you have years like 2022 or 2018, those were liquidity tides leaving the market. And so Bitcoin did very, very poorly during those times, even though you had times like in a year like 2022, you had high inflation. So you need the combination of the two, the combination of high fiscal deficits and the concern and narrative around debasement, plus the liquidity backdrop. So we see a very ample liquidity backdrop today. Money supply growth is very ample. You look at all the different portions of the market is confirming a robust liquidity environment. Could the Fed cutting rates add lighter fluid to that robust liquidity environment? Potentially. Could you also see on the inverse an environment where all of this funding of treasuries has some kind of crowding out dynamic that could cause liquidity to recede? That's, I think, a thought experiment worth happening that I don't know if Bitcoin would like that environment. So it has a place in portfolios if you're trying to hedge against those risks and want exposure to liquidity. So it's kind of like two things. You want exposure to doomsday prepping plus liquidity. The combination of those two things, Bitcoin can be an efficient way to do that. One last thing, just on the idea of fixed supply and stocks, large cap stocks have a shrinking supply. Mm-hmm. You've had huge buybacks this year, record buybacks, despite all the uncertainty.
Yeah, I saw that in your note. I was shocked how big the buybacks have been. I haven't been paying attention to it. It's been big.
It's one of the reasons we think that stocks continue to trade at such high valuations is that you have increased demand for stocks because of all this liquidity sloshing around, but supply continues to shrink. net equity issuance has been negative for the last 3 years. So, take your Bitcoin in its fixed supply, but don't forget how large cap equities have shrinking supply.
Yeah, for sure. Well, it's always great to have you on, Cameron. This timing couldn't be better. Hopefully you'll come on next quarter, right? And for people that want to find you at NewEdge Wealth, how do they go in there and find your stuff? I know you put it out everywhere. You're prolific. You're on TV. You're on places. But where's the best place to go find your
So
stuff?
we have a website called NewEdgeWealth.com where you can sign up for the weekly written report. We also just made it possible to get my Monday charts by signing up there. So that's usually been something that's been a bit more private. But those get published every single Monday. Brian, Nick, my colleague, and I publish a whole suite of charts. Sometimes it's 10, sometimes it's 25. So you're welcome. It's all the stuff that we find interesting. Then I'm on LinkedIn as well, on X occasionally, and
Well, I'm sure you'll be tweeting or Xing or Instagramming from the Pixies concert tonight. So I know you like to put those out as well. So full entertainment. You get the entertainment, you get the market knowledge. Cameron, thanks for coming on the tape.
Where is my mind?
Exactly. Where is my mind? You got it. Thank you, Cameron.
Thank you.